Welcome to The Explainer. You know, the rules of global business, they're literally being rewritten right beneath our feet. From massive international treaties signed in Geneva, straight to the bustling factory floors in East Asia, all the way down to, well, your local corporate tax return. The entire landscape of global commerce is shifting, and it's shifting fast. Which really brings us to the core question we're diving into today. How exactly are the rules of global commerce changing? We're going to take a macro to micro journey through the global economy. As you'll see, we'll track how these high-level international pressures eventually filter all the way down to alter how everyday businesses actually operate and compete. Here is our roadmap for today. 1. Global trade rules under stress. 2. The national security loophole. 3. Shifts in global manufacturing. And 4. Updating domestic business taxes. Let's jump right into Section 1. Global trade rules under stress. The struggle between states and international organizations. At the macro level, there's this fascinating core conflict right at the heart of international trade law. It's kind of like a giant tug of war. On one side, we have national sovereignty. Obviously, nations have an inherent right and duty to protect the welfare and security of their own citizens, right? But to actually participate in global free trade, they have to cede a bit of that sovereignty to an international body, in this case, the World Trade Organization, or WTO. Then on the other side of the rope, you have WTO legitimacy. For a rules-based free trade system to actually work, well, the rules have to be binding. If countries can just ignore the rules whenever they feel like it, the whole system just collapses. So you have nations demanding flexibility for their security, while the WTO demands compliance to maintain its authority. It's a tricky balance.
Thank you for watching. Please like and subscribe to our channel.
Moving on to Section 2. The National Security Loophole, Article 21 of GAT 1994. Okay, let's break down the legalese here for a second. Article 21 is widely known as the National Security Exception, and the absolutely crucial point is right there in the phrasing. It allows a country to take any action, quote, which it considers necessary for its essential security interests. Those 4 words, which it considers necessary, are highly debated. Why? Because they essentially create a self-judging loophole. It implies the country itself gets to decide if it's breaking the rules for a valid security reason, which leaves the WTO with practically zero power to review the action. Now, for decades, countries basically operated on an honor system when it came to this loophole. It's true. Back in the 1950s, Sweden actually tried to use this national security exception to protect its domestic shoe industry. Their argument, quote, an army must have shoes. No way, right? Now, they eventually backed down, but it really showed everyone how easily this rule could be stretched. We saw it pop up again in the 1980s with the US and Nicaragua, but it actually wasn't until 2019 in the Russia traffic in transit case involving Ukraine that the WTO finally published a landmark decision. They actually applied a good faith standard of review to this exception for the very first time. But this legal stress test, it isn't just history. It's happening right now. The United States has invoked this exact same Article 21 to defend its Section 232 tariffs on steel and aluminum against China. The U.S. argument centers on the idea that domestic steel and aluminum capacity is, absolutely vital for national defense and infrastructure, making it a matter of essential security. This perfectly encapsulates that exact tension we talked about earlier between a nation's sovereign right to protect its industries and the international community's desire for unrestricted free trade. All right. Zooming in a bit, let's hit Section 3, Shifts in Global Manufacturing, the Regional Battleground. Check out this stat. In a recent survey, only 32.4% of South Korean manufacturing companies believe their technological competitiveness is still ahead of China's. To put that into perspective, back in 2010, nearly 90% felt they were ahead. That is a massive drop in confidence in just over a decade. It signals a monumental shift in regional manufacturing dominance. So where is that competition hurting the most? Well, it's price. Chinese products are just massively undercutting South Korean products. According to the data, Chinese semiconductors are priced at about 65% of the cost of South Korean ones. For batteries, it's 73%, and for textiles, it's 75%. And look, this isn't just about cheap labor anymore. China's immense scale, their massive government subsidies for equipment upgrades, and incredible efficiency gains, it's allowing them to push prices to absolute rock-bottom levels while still maintaining quality. There's actually an ancient Chinese proverb cited in our source material that hits the nail on the head. 1 force defeats 10 skills. Basically, it means that overwhelming scale and sheer workforce volume can simply bulldoze through traditional, nuanced technical barriers. By leveraging a vast workforce, totally comprehensive industrial sectors, and incredibly robust supply chains, China is overwhelming the traditional skills or technological leads that countries like South Korea used to rely on. For any business leaders watching this, it's a pretty stark reminder of what happens when massive volume and efficiency meet full government backing. And you can really see the sheer momentum of that scale in the data. The Semiconductor Industry Association confirms that by 2027, China's mature chip production capacity is projected to reach an astonishing 39% of the entire global market. That's huge. They are rapidly becoming the absolute center of gravity for the world's manufacturing value added. Meanwhile, as China heavily subsidizes its industries, competitors are really struggling to mount a domestic response. For instance, in late 2024, South Korea failed to pass the K-CHIPS Act. This was a crucial piece of domestic tax support legislation meant to help its semiconductor industry maintain its global position. So without that domestic tax relief, South Korean manufacturers are left incredibly vulnerable in this rapidly shifting global market. Which brings us all the way down to the micro level in Section 4. Updating domestic business taxes, adapting at the micro level. So, how do individual countries actually fortify their local businesses against these massive regional and global pressures? Well, they use domestic tax policy. Enter the newly enacted One Big Beautiful Bill Act in the United States. This legislation is a direct attempt to simplify compliance and adjust limitations for domestic companies. A really massive part of this act was taking several temporary business tax provisions and just making them permanent. The goal here is to give businesses a stable, predictable footing so they can actually compete and grow. One of the most critical permanent features of this act is the Section 199A Qualified Business Income, or QBI, deduction. Now, if you run a pass-through entity, which, by the way, is over 90% of U.S. businesses, this is absolutely huge for you. Here's how it breaks down. If your income is under $364,200, you get the full 20% deduction. No strings attached. If you fall between $364,200 and $464,200, certain wage and asset limits start to phase in. And if your income is over $464,200, well then you are fully subject to those limitations. But making this permanent, it gives domestic businesses the long-term predictability they desperately need when facing such fierce international competition. But, it's not all just giving out free deductions. There are also guardrails in place. The legislation addresses Section 163J, which is a domestic tax rule specifically designed to limit exactly how much business interest you can deduct. The core philosophy here is pretty straightforward. Prevent businesses from excessively using debt to finance their operations, because relying too heavily on debt can lead to risky financial behavior that weakens the domestic economy over time. To really see how strict these guardrails are getting, just look at the shift in how the limit is calculated. Between 2018 and 2021, the calculation allowed you to add back depreciation and amortization, so essentially an EBITDA-based approach. But from 2022 to 2024, those add-backs expired, moving us straight to an EBIT-based calculation. So what's the catch? By removing those add-backs, your calculated income is lower, and that means the amount of interest you're allowed to deduct is much more restricted. It's a fascinating micro-level policy specifically designed to force businesses to rely way less on debt and a lot more on actual revenue. And wow, that brings us to the end of our journey today. We've gone from countries utilizing self-judging national security loopholes at the WTO to the sheer overwhelming scale of Chinese manufacturing outpricing its competitors, right down to how domestic tax policies like QBI and interest limitations are being rewritten just to fortify local businesses. It's all connected. So the ultimate question I want to leave you with today is this. As the ground literally moves beneath us, how will your business or your nation adapt to these macro, regional, and micro shifts in the global economy? Thank you so much for joining me for this explainer. Keep learning, stay curious, and I'll see you next time.